Late October in eastern North Carolina, a mid-sized farm operation is pushing to clear its fields before the first heavy frost of the season. For most of the year, this specific operation runs lean. They maintain a steady payroll of exactly 8 permanent, year-round employees. To handle the late-season harvest volume, gets caught in a piece of harvesting equipment, suffering a severe arm injury that requires immediate surgery and long-term rehabilitation. The farm owner believed that because the 2 new hires were temporary, they didn't require workers' compensation coverage. That incorrect assumption triggered a state audit, turning a routine harvest injury into a devastating liability event. The audit centered on a specific piece of state law, North Carolina General Statute 9713B. This statute outlines an agricultural exemption. It states that farms are exempt from mandatory workers' compensation insurance, provided they employ fewer than 10 regular employees. Look at this ledger. By adding those 2 seasonal workers, the farm reached exactly 10 employees. Because they had no policy in place when the injury occurred, the state assesses an immediate $20,000 penalty for operating as an uninsured employer. That state penalty is just the beginning. The farm owner is also held directly liable for every dollar of the injured worker's medical bills and ongoing indemnity costs. North Carolina's agricultural exemption offers no grace period. It vanishes the exact moment an operation reaches 10 employees. This calendar timeline illustrates a common employer mistake. Many farm owners assume the 10-person threshold is calculated as an annual average. It is not. North Carolina uses a strict point-in-time rule. If your head count reaches 10 employees for even a single day during a peak harvest push, you are a covered employer for the entire expansion period. The defense usually pivots here. Employers argue that temporary harvest workers are casual labor, not regular employees, and therefore shouldn't count toward the threshold. The North Carolina Industrial Commission decides this based on 2 criteria. First, they examine the nature of the work. If the worker is harvesting crops, driving tractors, or performing tasks integral to the farm's core survival, their function is essential. Second, they look at continuity. If a farm relies on the same seasonal crews or expects temporary workers to return for the harvest season year after year, an ongoing employment relationship exists. The fact that the work only lasts for 3 weeks does not classify the worker as casual. Because harvest crews perform essential operations and often return seasonally, the state legally counts them toward the 10-person threshold, exactly like permanent staff. Recognizing this risk, a farm might try to bypass direct hiring altogether by bringing in a third-party labor contractor to supply the harvest crew. This organizational tree maps out the contractor attribution risk. The farm hires the contractor, and the contractor brings in 15 crew members. The legal trap springs if that middleman contractor does not hold their own active workers' compensation policy. When an uninsured contractor enters the property, the state intervenes. Under the law, the state pierces the middle tier and transfers the entire headcount of the uninsured contractor directly to the farm owner. They become your statutory employees. A farm with 5 permanent workers that brings in 15 uninsured contract workers now legally has 20 employees. The exemption is instantly shattered. The state then audits the timeline. They assess a penalty of $100 per day for every single day the farm operated above the threshold without coverage. Outsourcing your labor force does not outsource your legal liability. The only defense is verifying an active certificate of insurance from the contractor before anyone steps foot in the fields. When confronted with these risks, some agricultural employers point to their standard farm liability or homeowner's insurance rider, assuming it will cover an injured picker. This magnified view of a generic farm liability document reveals a specific policy exclusion. These contracts explicitly exclude injuries to individuals who qualify as employees under the Workers' Compensation Act. The moment the Industrial Commission defines your seasonal worker as a regular employee, your homeowner's policy will automatically deny the claim. There is no secondary coverage. The farm owner is left entirely exposed, paying out of pocket for surgeries, physical therapy, and lost wages. A farm writer cannot legally or financially substitute for a dedicated workers' compensation policy. Even for farms that meticulously audit their headcount and legally maintain fewer than 10 total workers, operating without coverage carries a significant threat. Farms operating legally under the exemption still bear total civil negligence liability if a worker is injured on their property. The workers' comp system limits payouts to strictly defined medical and wage benefits. Outside of that system, an injured worker can file a civil lawsuit, where a jury can award uncapped damages for pain and suffering. Purchasing a workers' comp policy provides an employer with exclusive remedy protection. This is the legal shield that blocks an injured worker from suing the farm in civil court. For operations of any size, paying a premium to secure exclusive remedy costs a fraction of what it takes to survive a single negligence verdict. Agricultural compliance in North Carolina requires constant vigilance. Employers must stop treating the 10-person threshold as a static annual benchmark and start reassessing it at every operational shift. First, audit headcount when seasonal labor expands. Hitting 10 people for one day requires a policy. Second, verify certificates of insurance from all labor contractors, preventing their crews from becoming your statutory employees. Third, secure a dedicated policy to eliminate uncapped civil lawsuit exposure. Managing agricultural risk comes down to point-in-time math and proactive verification. Treating seasonal labor as a legal blind spot is the fastest way to turn a single harvest into a multi-year financial disaster.